Hello, everybody. Thank you for joining us on today's webinar, The Hierarchy of Protection, Mastering the CRE Capital Stack. Before we get started, I do have to read a brief disclaimer. The Entrust Group does not provide investment advice or endorse any products. All information and materials are for educational purposes only. All parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering any type of investment. On today's webinar, we will cover Commercial Real Estate 101, how to reduce your risk, and explore some case studies. At the end of our presentation today, we will have time for a question and answer period. My name is Tony Uncle, and I will be your host today. I'm in my 9th year at Entrust, and I pride myself on educating investors and professionals on a tax-preferred retirement accounts and alternative investments. A little bit about the Entrust Group. We are self-directed IRA administrators. We have knowledgeable staff with CISP certifications, and we hold these monthly educational webinars. We currently have a little over $5 billion in assets under administration, with 24,000 plus active investors and over 40 years of experience. One of our main benefits is a single point of contact model. Depending on the region of the country you are in, you will be assigned a specific individual to help with all your self-directed needs. That's been enough for us for Entrust for now. I would like to turn it over to our host and guest host, Joe Burko. Joe is a highly esteemed entrepreneur with over 30 years of experience in the real estate industry. As founder of CEO of CRE Capital, he is a distinguished private equity real estate firm. Joe has propelled the firm to the forefront of the industry. CRE Realty Capital specializes in lucrative investments across major U.S. markets, employing a strategic combination of equity and debt to maximize return, and participated in over $3 billion worth of diversified assets. The Entrust Group and CRE Capital have been working together to self-direct investments for over 6 years now, and we are happy to share our presentation with them. Joe, it's all you.
Tony, thank you. Great to be here. Thank you also, Andrew, and the rest of the team of Entrust, and of course the team of CRE Realty Capital. Great to be here. Wonderful to have you. Some of you are investing with us. Others are maybe considering investing with us. We're very excited always to do anything that is educational in nature in order to bring some awareness to the alternative options that you have on your investment universe. We do believe that there's great to have a balanced portfolio that does include some alternatives, and within those, of course, real estate should take some kind of a stake, a prominent stake, a minor stake, but certainly have some real estate in your portfolio. Typically, it goes sort of like counterintuitive to how the market is, and it certainly gives you a nice, balanced situation. A little bit about myself and CRE Realty Capital. We'll go through this, but I'll give you sort of like the background, not just the what we do and how we do it, but also why we do what we do. So my background is, at this point, 30 years in the real estate arena. I started from New York City in 1995. First 20 years of my career, I ran a shop that I started in New York City called Burko and Associates. Burko essentially specialized in representing developers and various funds, various groups in the acquisitions, dispositions, financing, and capital raise for various projects, primarily in New York City, very, very large, competitive, very fast-paced market, but also across the nation. Over the years, we've won multiple awards for the work that we've done. We worked on some very hard transactions, very tough transactions. We were called and referred to as the snipers in the market. Our type of strategy that we've used was quite different than the ones that are maybe the largest shop, the CBREs or the JLLs, or some of those familiar names that are more sort of like relying on collecting information and spreading it out. We were called in to fix situation where things didn't go the right way. Maybe the bank was not happy with the borrower and we had to step in. Maybe there were two partners fighting. So we've seen a lot of situations, certainly in a large base environment like New York City and large ticket items where some of the transactions can go well above $100 million. Those, who take front page newspapers and so like get a lot of press and coverage, we always know how to keep it quiet. And so we have got a lot of those assumptions. After 20 years of doing that, I decided to pivot. So sometime around 2015, I decided to pivot and placed my focus on the segment of the real estate universe, right? The overall universe between the funds and the investors and all those different things and the developers and the banks, and focus exclusively on this one segment that I found to be the least represented and the one that seemed to be holding the bag, especially when things don't go the right way. And that segment is the investors. You see, when things go the right way, the developers get their credit and they get their reputation and they get the front page in the papers. But when things don't go the right way, it's typically too late for the investors to try and step in, to understand what is going on. And essentially, they're the ones losing the capital. And so I placed my own capital, my own money, that is of my family, our close friends, and we decided to start making investment and focus on investments across, well, started from New York, but then eventually spread out over many various markets across the United States. So really, it's kind of this conversation will talk about the various elements that we bring in, the various legal sides that we bring in. But I want you to keep in mind, as an investor or as a potential investor, that collectively we're a lot more powerful. And what I mean by that is you're getting deals thrown at you, all sorts of beautiful presentations with promises of high returns at various markets. They all look great. They all look very appetizing. What Aster is doing, what our company is doing, is basically saying, hold on, we're going to come in not as a single unit of investment with very little control, but rather as the collective bargaining. We'll come with a larger check, and we're going to be keeping our eyes on the ball and making sure that the investment is going to go according to plan, according to schedule, according to budget. And if it doesn't, then we will know in real time how to handle it. And so this is why we've started Aster Realty Capital. With that in mind, let's just open the presentation and let's discuss a little bit about what Aster has done on the last 10 years of operation. So what we consider as a competitive advantage, right, is first of all, understanding the real estate deal and looking at the deal not from the standpoint of how much returns we can achieve, but rather on its weakest leg, right? Can we preserve capital in the event that market shifts, and they always do, situation changes, black swan, pandemic is a good example. Can we preserve capital, right? It's one thing to make great returns. We all love that. But what happens if things shift, right? If I build a condo building, but I can't sell the condos, can I do a plan B? Can I rent the asset? Can I keep it? Can I maintain my capital until the market shifts again and I can sell the asset? The answer is a lot of times no. And so we drop those deals. It's probably worth mentioning that we go over 700 transactions a year. And we say no to about 98% of those transactions. So ongoing asset management, right? Your second competitive advantage, the ongoing asset management. As a private investor, you place your capital and you're sort of like at the mercy, I call it, you're at the mercy of the reporting coming from whoever the developer or whoever's running the project, right? There's nobody out there on your behalf that's going to take a look and verify that the information is in fact correct, that the steps taken are in fact the right steps. And so the ongoing asset management is something we take a big pride of. We're real time, lifetime, watching the ball, making sure things go according to plan. And if they don't, we address it immediately right away in order to cure the situation so it doesn't escalate further down. Above market returns, because we do have the expertise, because we're doing it, in my case, 30 years, the rest of my team as a collective, well over 65 years, we do have the ability to reach out to see a very big universe of transactions, hundreds and hundreds of transactions per year, and pick the right ones, right? When we have a much better pool to pick from, tend to pick the right one and analyze the risk accordingly. The alignment of interest, which is something that's very important to us, right? Those with skin in the game, stay in the game. We make sure that the managers, the developers that we work with really have something to lose, not just the game, but really have something to lose. Oftentimes we see developers show up, they bring us a deal, their skin in the game is 1 or 2%, very, very minuscule. By the time they close the deal with the amount of fees, they really don't have any real money in the deal. Those with skin in the game stay in the game. We make sure that there's an alignment of interest. If you risk your capital, I want to make sure that the developer risks his capital just as well. And consequently, we also do the same. On every transaction, I put my own money, and so is the executive team of Astor Realty Capital. And lastly, in a world where everything is AI-based and frictionless, as sometimes it's referred to, all sorts of crowdfunding sites and so on, click here, send the money there, no friction. If you want to talk to somebody, you're probably talking to some kind of a bot. We make it personal, right? This is what we call our friends, a club of friends and family. Everyone is connected. We have over 500 high net worth family office and institutions that are working with us. And each and every one of them came to us because they were referred to us, because somebody that they know has been working with us for a number of projects, sometimes a number of years, sometimes for the full 10 years that this company has been in operation, and they made a recommendation. Hey, these are good guys to work with. So it's very much personal. It's not just business. Quick snapshot. Every quarter, we issue a report that discusses all of the assets that we work on, the various steps that they are, the various stages, things that are completed are also there. We show the returns. We give a lot of transparency, and that I think is something that's extremely important. So it's not just the project that you might be in, but it also all the other 38 projects to date that we have. So to date, and from you are 13 different markets, top performing markets, 38 different transactions with 18 exits. And I suspect that by the end of this year, we're probably going to add another 6 or 7 exits as well to our portfolio. Overall, we're at $3 billion in real estate assets. That is, we take various positions in assets, whether it is we're building a 300-unit apartment building, we're taking a position in that, or whether we are the accompanying lender, or whether it is a preferred position. The overall mark to market represents $3 billion as of today, with over 3,600 units coming out of the ground or completed that include condos, that include multifamily rentals, that includes hotel units and logistical centers, and even some retail as well. From inception, we've raised $259 million, and the overall square footage of all projects combined is $4.6 million. 4.6 million square feet. Our team has been with us from some of them, even from the previous companies, as I mentioned. We started as Berker and Associates years ago. So for the first 20 years, we're Berker and Associates. The last 10 years, as I said, it's Astor Realty Capital. The focus has shifted. The work has not, right? We are here to empower investors. Our associates are across the United States. Kevin is in Texas. Alex is in DC. Laura is in Colorado, Andrew is in New Jersey, and Nuri is offshore. Our members, various positions, and even my oldest son, Maxwell, who just turned 19, is our new part of the new junior analyst team. Quick snapshot of some of the assets that we have. On the top left, you have an asset that we're very proud of. It's called the Caesar Republic, the first non-gaming Caesars in the United States. In Scottsdale, Arizona. We have Bergen Street, $259 million project, the Legacy project in downtown Miami. It's a 50-story tower with 3 different compartments, including a hotel, including condominiums. Bay Harbor, Brooklyn, other Brooklyn projects, various location, Dania Beach, Fort Lauderdale. You can have access to our website. All of those projects are constantly getting updated. We're very much focused on working with top-notch developers, creating the right kind of structures and the right kind of partnerships in order to preserve capital, in order to make sure that we reach the kind of return that the risk that we're taking are in fact warranted. Now let's talk about what goes behind the scene, okay? What we call here the hierarchy of protection. Basically, what we do is we're analyzing risk. Okay, that's what we do. We just sort of chose to do it in real estate, but altogether, we're here to analyze risk. And risk basically represents various parts of the capital stack. So what is a capital stack? Capital stack essentially represents either the capital or the debt, which basically will be the entire capital, the entire money that goes into a project. All right, so in a typical scenario, there's a senior lender, right? Represents maybe 70% of total project cost. And then there's the LP/GP, limited partner equity, and the developer equity, right? In here, we typically ask for 20% developer, right? And we'll bring, as a collective, the collective bargaining will be about 80%. It doesn't mean that we have to be 80%, but certainly we want to see that we are taking a majority stake and we have what we call majority control. So the various players in a typical deal like this will either be a developer, which will be basically bringing us the deal, has the experience, comes to us already pretty much fully prepared. It might be in contract on a piece of land, already designed, it already has the zoning approved, all that good stuff is sort of like have been checked and verified. And so they show up, we're looking at the budget, we study the budget, we compare the budget to other similar projects to see where we are, to see if everything is aligned. And their job is to basically what we call manage the day-to-day, right? They're on site with the construction, with their team, managing the day-to-day. The limited partner is our position. This is an equity deal. We have different deals that we do, but in our position, the limited partner is us. And basically, we are the one who's supplying the project with 80% of the equity, like in this example. As I said, can be less, doesn't have to be 80, but certainly it's capital is coming from the limited partners. So what do the limited partners have? We basically are participating in the upside, and we create a structure where once the project is completed, sold, exited, basically we have a split with the developer. Because we're coming in with a larger check, we'll have more a way to throw our weight around, right? And to kind of like get a better structure of return between us and the developer. And of course, that trickles down to you, the investors. We avoid taking any signatures on debt. All right. So this is the onerous is on the developer himself. We make sure that we are protected from capital calls. It's something that we negotiate, avoid any capital calls. We basically say to the developer, you put the budget together. If there's a capital call, it's because you caused it. And so it's up to you. You have the onerous to make sure that you can bring the capital. We always make sure that we work with groups that have money, right? So it's not their last dollar in this project because things do happen. And of course, we have the lender, right? The lender is a senior capital. They basically are the one that are funding the project through requisitions as the progress continues. Basically, they'll bring various parts, and we make sure that we're working with a reputable lender, a lender that's not going to overcharge us, that's not going to cause any issues, but certainly a lender that has the capacity to do what needs to be done over the course of the project. And so, the sort of like the life cycle of a project, right? Land gets contracted, developer steps in, get the project approved, start the project. private equity, which is us, bank financing is being sourced, construction starts, lease up, exit, and repeat. Okay, so some pretty intuitive stuff here. How do we maintain control and reduce the risk? Okay, which is really what our job to be as a group that represents investors' capital, represents our own capital as well. We make sure that first we choose a market that we know, love, and trust, right? We have to choose a solid market. Market shifts are sometimes a situation where there's oversupply, sometimes the demand is very weak. We want to make sure that we're focused on top US markets. So that's one thing I want you to take. Location is king, right? You want to be in top performing markets, the type of markets that attracts jobs, high paying jobs preferably, all right? But certainly we want to see job growth. The second thing is we want to see population growth. Those are the two determining factors that will help us make sure that once the project is completed, there's going to be people occupying it. There's going to be individuals that's going to be buying condos if that's the project, making sure that the dynamic is right for this type of a project. As I mentioned, we go through hundreds of transactions. It's not uncommon to reach 600, 700 times a year. Various developers across the United States reach us with requests, come join us, be a partner, come lend us, come become a preferred equity partner. So we see a lot, we collect a lot of that information, and we store it. And when the right time comes, if we like a certain project and we love a certain type of development group, then we'll come in at the right time. We'll already have tons of information about the area, and we'll be able to make a quick determination. And so those things are very important. Now, looking at the sponsor himself, we want to see that the sponsor that we choose to work with has a serious track record building the exact same type of a product, right? So if he's a builder that builds multifamily, I want to see that for a long period of time, typically around 20, 25 years, this individual or that group have been building multifamily in the exact location, the exact geographic location. We try to stay away from folks that are building hotels, but then decide to jump into multifamily. We stay away from those situations. We want to make sure that the asset class is a fit and they have multiple years. Okay, as I mentioned, 25 years. It's not uncommon for us to work with groups that have been around for 40 years and 45 years and second generation developers. We love that because that's the experience we'll look for, right? We want to make sure that we negotiate, okay, a fair type of splits between us and the developer. Sometimes we see requests where people are asking us 50-50 splits. We're coming in with all the capital or 80% of it. The splits are not fair. The returns don't represent the kind of a deal. So we negotiate if we like the project. We want to make sure that everybody makes money. We certainly want to see that your capital, who's at risk, is actually making the type of return that are reasonable for the type of projects we're doing. And we do sensitivity analysis. We study the market, right? If we're building a rental, we make sure that we understand the universe of rental. What are units renting for? Who's building? How successful they are. We'll go visit the various projects. We're going to walk various projects, talk to the local brokers, do the legwork that's necessary outside of the computer, right? Today, everything is available online. I say that, information today is available widely for everyone, yet most people understand very little about the values of things. And then we negotiate a legal contract, right? And in the legal contract, we'll put in all the reporting requirements, what control we have, how do we maintain major decisions, how do we take over the asset or replace the developer if they don't do the right things. Those things are extremely important. And once the developer knows that he's dealing with a group, right, that has their eyes on the project, they're going to do the right thing because, essentially, we have so much control over any given situation. And they know that there's so many eyes on it that it's very, very difficult for a developer to do something that is not the right thing by its investors. Our typical takeover provisions, we negotiate very strong about what does it mean in the event that things don't go the right way. If there's negligence, if there's any bad acts, what we do is we negotiate that first of all, we take over the company and then we start managing the situation from the inside. As opposed to most contracts basically says, well, if you're not happy with the project, or the way the projects are being handled, then you can go and sue for control. No, the first thing we do is we take control, right? This is your money that we're protecting. This is our money that it's in the project. First, we take control. If the developer is not happy with our actions, then he can go and try to fight it out. But that's the first thing we do. And then we look at the situation. If it's a completed building, then we find out what's the right way. We have a right to force a sale. We have the right to take over, refinance, to do whatever needs to be done in order to protect the capital. And protection calls and additional capital needed or anything, as I mentioned before, we make sure that if there's any additional capital needed, those dreaded capital calls doesn't become an obligation of our group, right? It becomes an obligation of the developer who's running the day-to-day budget. If he decided to change the budget, if he decided to do last-minute revisions and add things that we didn't agree on, then it's on the developer himself. I'd love to share with you a little bit of case studies of some projects that we've done. So this, I think, is a good case study. It's a project that we've started in 2021, building 293 apartment units, Class A rental building located in a place called Dania Beach. We love the project. We love the location. We recognized very early on Miami and South Florida is a very, very booming market. Rents have doubled, and in some cases, they've even tripled in a very short period of time. So we wanted to be close enough to centers of employment, close enough to retail and shopping, close enough to the beach, but then a little bit far enough, okay? So we don't have to pay the high, so our tenants don't have to pay the high rents. We already recognize that there's going to be a very strong demand for young families and professionals and so on. There's going to look to sort of like move around and be somewhere where they can afford those type of rents. And so this represents a great deal. This comes with a developer who's been around the block for about 40 years in Florida. So we went into the project, but yet we decided to reduce the risk by creating a class of our own, right? We only came in with $4.3 million, represents about 20-something% of the project. We couldn't have the control that we wanted to with this type of a position, right? We were not the major position. We couldn't have the type of control. So we've negotiated something else. It's called preferred equity. So we said, look, the project shows amazing returns, and I'm sure you'll reach them, and I'm sure that there's not going to be any problems, Mr. Developer. However, all we want is once the bank is paid, our capital, gets paid first, and we want to tag along a coupon of 18% a year, plus a little bit of a profit kicker towards the back end. That will pretty much give us around a 19.5, 20% return. At the time, it sounded great for the developers and everybody else because that would mean that they will need less money for the project, and it's easy to arrange a 20% return when the project showed us close to 30. So they've taken our proposal, and we came in as preferred equity. Fast forward 4 years. Basically, the project is completed, beautiful project, fully leased, over 96, 97% leased, and yet the project went through a bunch of delays. There were cost overrun to the tune of 20-something billion dollars more. Because we've negotiated that we don't have to participate in any capital call, and because we've negotiated that our capital is getting an 18% and a priority over all the other capital, our position as maintained being in the more secured position in the project. We have the right to force a sale. We essentially are the only group in the project that's making the type of returns, but because of the cost overrun, because it took longer for the project to complete and to build, our group is still maintaining the 18% plus the kicker, and our position is very safe. How safe? The project is now valued at around $125, $130 million. The bank's position is around $86 million. Our last dollars, right? So the bank at 86, our last dollar places us at a risk level of somewhere in the vicinity of around $93, $94 million, right? Because we've invested 4.3, but we also accrued 18% a year over the course of 4 years. So our last dollars risk position is $93, $94 million, right? So the equity itself is not going to be making good money because the total project cost is somewhere in the vicinity of 113, 114. Certainly not enough to, just enough to pay back the equity and to make a little bit of profit, but just not the type of return that they've expected. However, our position is the more secured position. If we had to sell this project, we have the right to force the sale. We could sell it tomorrow, even though during the fire sale, and our position will be certainly very much secured. So that's a good example of preferred equity. Case study number 2, Brooklyn, New York, which has gone into a project. I think we closed it in sometime in December. We're building 117 units, Class A apartment building. We're 80% of the equity in this project. Strong developer, over 30 years. The type of developer that builds and holds. He's got over 100 buildings. He'd never, ever sell. He amasses a tremendously large portfolio, over $2.4 billion in portfolios and in assets, and a massive cash flow coming from over 100 buildings. I think over 2,400 apartment units that are paying rent on a monthly basis. And so we've negotiated a preferred equity position and generated return to our investors. I'm going to skip the return part. We're not supposed to talk about it from compliance purposes, but ultimately we have a very strong, solid group. We've done like 7 or 8 different projects with these guys. This is a short-term project. We come in, we build. Again, we're at the preferred equity position. We've negotiated something different, and that is called a personal guarantee. With this particular developer, because he's got an amazing cash flow, because he's got very deep pockets, we've negotiated a personal guarantee protecting our capital in the event of, right? So we have all those extra things. We can force a sale, we can take over the project, anything that we have in all the other projects, but we've pushed it one step further and we've asked for personal guarantee on our investment amount. Case study number 3. We do play across the capital stack, right? We are in equity, we're in preferred equity, and we're also in debt position. In this particular case, we are lenders, right? So we are lending to this project. This is a project in Newark, New Jersey. It's called the Ironbound section of Newark, New Jersey, blue collar section, growing section, close to Manhattan, close to centers of business. The developer has acquired 4 pieces of land, 2 buildings he already created. This is the 3rd building. And so he came to us and said, I need money for the construction of this project. Overall project cost is about $27 million. We're lending $23 million. And so by reducing the risk, right? I mean, the more you are, the upper you are in the stack, the more risk you take, the more higher returns you want to create. By reducing the risk, we've actually created ourselves to be the bank. And so what we're doing here is, in fact, we're lending to this project, and we're doing it by requisition. There's a developer who's got 35 years of experience, been doing what he's doing for a very long period of time, and building this rental building. He also builds and holds. And so in this project, we're going to be giving him money by requisitions. Now, how do we maintain a double-digit return or how kind of like mid-level, mid-teen returns? We're basically bifurcating the loan. We're making the loan at a certain rate. We're taking some of this money. We're bringing a local bank to partner up with us. We pay the bank a lot less. And so we together are enjoying a higher return, creating sort of like, very nice risk-adjusted return for this type of a project. So if you think about those 3 scenarios, then you understand sort of like what we do. We look at projects, we negotiate very strongly, we maintain control, we maintain the right to step in, and we make sure that our capital is preserved, as I said. What's next for Aster? Let's talk about the overall market condition. We're looking into I like to explain it if you can think about an analog clock, right? Think about an analog clock. At the top, you got 12, the center point at the bottom will be 6. Okay, so that represents for us somewhat of a 12-year cycle, right? Like any industry, real estate is cyclical. There's the up market, there's the down market, and there's anything in between. It's typically represented by somewhere between 10 to 12 years cycles, right? Peak to trough. If you'll consider that within that 12-year cycle, you have 4 quadrants, right? Each and every one of those quadrants represents different time in the market, right? If you look at the first part, kind of like the downturn coming from 12 o'clock being the peak of the market, the downturn represents basically anything between 12 and call it 3 o'clock, 4 o'clock, where we see a market in a downturn. We pretty much saw a downturn in March of 2022 when the Feds decided to spike up interest rate in a very, very sharp period of time of about 6 months. We've seen the market basically taking a very big hit, right? And so as managers, the first thing we've done, recognizing that this is the beginning of a drop, we've stopped operation. All we've done was asset management, but no new deals. We waited for about 3 years before we jumped into our first deal, and sometime around middle of or late 2024, we stepped back into the market. Why? Because the downturn, right? If you think about 12 to 3 represents a period of time when we decided it's time to hold. Presenting the period of time between 3 to 5 is the period of time when we started going back into the market. Why? Because that's when most capital disappears from the market. The large players are not there, and we can do the best possible deals. Consider the following, right? When the market is certainly very much down, we'll never know exactly when is the 6 o'clock point, but when the market is down is when you want to start getting back in. And so we started doing deals, preferred equity deals, and equity deals where we believe we're going to see the biggest rewards because it takes a good 2, 3 years, 4 years to finish a project. And so by the time we'll exit, we're going to see a different market, a market in an upswing. If you ask me where we are today, I probably think we passed the 6 o'clock point, represented by very strong economy, right? In the last quarter, GDP growth was over 4%. Projected this quarter, GDP growth between 4 and 5%, unprecedented numbers. We're seeing drops in interest rates. We're seeing capital that's been on the sideline for many, many years starting to look back again, starting to come in again, starting to be a lot more activity in the market. Banks that were on the sidelines or were lending, but in a very kind of like a slow period or maybe in a conservative basis, are starting to open up again. And once capital starts coming back into the market, we're basically coming in, we're seeing a market upturn. And that's usually represent that period of time. Again, a wonderful period of time. If you ask me, the best period of time to invest is somewhere between 3 and 9, right? The downturn was when you see a lot of good deals, and then you continue swinging up with the market until such time that you hit the 9 o'clock point. Okay, of course, we never know exactly what's the 9 o'clock, what's the 6, what's the 3, but we sort of like move along with the swing with our fingers on the pulse. What happens at the last period of time, right? The last period of time, I consider that period of time to be a great selling point. Holding real estate, that usually represent a period of time where banks are open, the funds are basically throwing money in, there's a lot of liquidity in the market, there's the euphoria type of a stage. You might be going into a cab, and the cabbie is going to tell you about how he's putting a down payment to buy condos in Florida, and you'll see all sorts of newspapers that are saying another record breaker and another huge deal happened, and all this sort of like that period of time. It's a great period of time to sort of like hold on for a second, reassess what you have, not necessarily start new project, but rather look at the ones that you have and consider selling it, right? So somewhere between 9 and 12, you want to be in that period and consider selling your asset. You're going to sell it for the highest amount and basically going to make the largest returns, right? So this is the 12-year cycle. 2026 represents for us a an environment where we want to be all in into the market. We're seeing the start of the beginning of the rise and start to move fairly quickly. Our objective is to capture a few transactions, 6 to 8 transactions during this year. We already signed up first. We're doing it as a fund, giving our investors the potential to create a beautiful diversification and to be in multiple projects. And our focus is on income. Our objective is to create mid-teen type of returns. I'm not going to expand too much about the returns. And in this conversation, we can have a one-on-one conversation with myself or the team, and we can explain more about our activity. But ultimately, we created the One Aster Income Fund. It's a $45 million fund, short period of time, 3.5 years. Our objective is to catch as many projects that we can while interest rate is still reasonably high. 6 to 8 projects, as I said, create diversification and make sure that those projects are here so that we can see those, basically the returns in 2026, 27, 28. Okay, when interest rate will start dropping, we still have locked in deals that are still paying us very reasonably high interest rate. And so that's sort of like where we see activity. I welcome each and every one of you to scan the QR code, drop a line, set up a conversation with members of our team or with myself, and learn more about our activity, be part of everything else that we're doing. Let me move over to the other part here. Yeah, I think that's worth mentioning. The market selection that we have, I mentioned before, the geographic locations are very important to us. And so, we're looking very heavily into Arizona. We're contrarian about Arizona, not necessarily ready to move into multifamily in Arizona because as it's a very saturated state, but certainly looking into it. Texas is a very strong market. We're obviously seeing the demand. We're seeing the growth of income. We're seeing more companies anywhere else in the United States. There's more companies that are being formed in Texas than anywhere else in the United States. Maybe second to none only to Florida. And certainly South Florida is a market that we're very active. We love this market. In Texas, for us, Texas is essentially Dallas. We're pretty much snobbing all the other markets. We feel that Dallas is the market in Texas. We have some evasion towards other markets for various reasons, which we don't have to go into, but a lot of them have to do with oversupply and the ease of entry to the market. So Texas represents a really good balanced type of a market. Colorado, certain parts representing good markets for us. Georgia is a market we're looking at. South Carolina, to some extent, North Carolina, especially Durham, Raleigh-Durham, and Charlotte is a very strong market. We're seeing good growth. Tennessee, basically, also represent for us a little bit of an oversupply right now. So we're looking at this with a good grain of salt. Virginia, parts of Pennsylvania we're looking at, and of course, New York City, where we've created a career, and other parts of the Northeast. Again, those are anomalies, right? When we go into a project, we take various levels of risk, and our job is to reduce the risk and maintain situations where we can essentially get you reasonably high returns and then preserve capital. We're at the top of our 45 minutes, give or take. I'm happy we reached that point without going over it. I know it's interesting for us, right? We can talk real estate all day long. But I want to take a second and read you a mission statement before we sum up and before we're going to go to questions, so you pretty much understand what we stand for and why we do what we do. At Aster Realty Capital, we believe in breaking traditional boundaries by leveraging our collective bargaining power. We're dedicated to leading our community of investors towards financial security and growth with integrity, authenticity, and transparency. For us, it's not just business, it's personal. And with that, I want to thank you all for taking the time and listening to our conversations. Any questions? I'm here.
Thank you, Joe. We do have a couple more intro slides to wrap up before we get to the Q&A.
Oh, okay.
You just have to pass over control.
Let me see how I do that. Okay. You got it, Tony?
Yes, thank you. What's next on the Entrust agenda? We'll be sending you the replay and additional resources. Our follow-up email will include the video replay, all the slides, and more education. And please don't forget to register for our next webinar this month, Farmland Investing with Your IRA, an expert introduction. Need more information on self-directed IRAs? Please visit our website and learning center, theentrustgroup.com. And now we can open it up for some Q&A. And I'll leave our contact information on the screen. So if you need to reach out to us directly, you can capture this here.
If there's no questions, I'm happy to again thank everyone for joining us today. Good seeing you, and certainly looking forward to hearing from you, having a conversation, understanding more of what your objectives are and how we can help you with your portfolio, with your investments, and hopefully see you among our growing group of investors.
Joe, we do
Thank
have one question for you. One just popped in. What is the minimum investment for Astor's new fund?
So the way we have it, it's $250,000 as a minimum investment. We call capital as we do the deals, right? So I'll explain. Our objective is to do 68 transactions over the course of the next 12 months. And so when a transaction gets signed up, we'll call the proportionate amount, right? So it might be $40,000 for the first deal and so on, 40,000 for the next deal. It'll be over the course of time. Of course, we make sure that everyone who's participating is an accredited investor. That's important to us. We do have the flexibility to participate on a single deal. And on a single deal, in other words, not part of the fund, we have the capacity to start from 50,000 or 100,000 without having to commit to the fund itself. So I'll say it differently. To the fund itself, the minimum is 250. Capital stays with the investor, and we call it as we go along. We sign a deal, we call it proportionate amount. For a single deal, we have what's known as a sidecar. You can participate in a single deal, and for that, we can start from as little as $50,000 to $100,000, and that gives you the flexibility.
Great, thank you. Have you done any projects in Western North Carolina?
No, not yet. Not yet. I think that North Carolina is a strong market. We're in conversation with a number of groups. We're looking for a very, very solid group. Our requirements are certainly up there. And so we've seen project, we're learning very nicely the market. But this will be our first entry into the North Carolina market. Our focus is going to be on Charlotte, and it's going to be on Durham.
Thank you. And other than the tax benefits of using your IRA to invest, do you participate in any tax credit deals? Perhaps you need to expand on that question a little more for you, or are you okay with that?
So, a lot of the projects that we do don't offer tax credits. And if they do offer tax credits, they come from a different angle. And we've done a transaction where we've had tax credit, sort of like a refund. It's called a brownfield tax credit. The ground was needed to be cleaned, and then we've got around $50 million, and that was kind of like part of the upside, but it's not in the sense of what you're thinking. When we do transactions that are in fact acquisition of existing projects, right? Like maybe buying a multifamily complex, then there are tax credits there are some tax benefits that we can offer, depreciation, accelerated depreciation, or all sorts of different bifurcation of it. But that's not our forte. Our forte is to get you very high returns, do it in a short period of time. And so when we do a project, for example, when we do a project that is condo based, right? Condo is very high taxed. And so we offer it only to those that are coming with a structure, like an IRA structure or various other structures our investors use. But typically, that's how we do it. The difference and the reason possibly is why we don't do this type of value add, as we call them, right? Existing properties, but rather build the ones, is because the returns are significantly higher and they're kind of like compressed to a short period of time, usually 3 years or so. We can create very high returns. Again, I'm trying to avoid saying the exact returns for compliance purposes for Tony and Andrew. But you can certainly go into our website and we have sort of like the deals that we've done and the exits, and you can see the returns in various projects, in equity projects.
Absolutely. You can also contact Joe directly, and he'll be happy to discuss the specific returns on specific projects with you directly. But he's correct, for compliance reasons, we cannot speak about that publicly. All right, we'll leave the Q&A section open for another couple seconds. If anybody wants to drop a question in for Joe or for myself, we're happy to answer. Otherwise, we can wrap up, and this webinar will be saved in our Learning Center and sent out to everybody, and our contact information will be included.